On Monday, February 2nd, reports hit the tape with a clean number. Tariffs on India would drop to 18%, tied to one condition. India would stop buying Russian oil. That is not a normal trade headline. That is a macro wiring change. Because oil is not a spreadsheet input. Oil is freight, grades, contracts, and timing. Here is the verified core. Reuters reported Indian refiners said they would need a wind-down period. They said February and March cargoes are already planned. So even if the policy goal is immediate, the physical clock is not. This is the promise. By the end, you will know what just moved. You will know why the first break shows up in odd places. And you will have 3 markers to watch this week. Lock in one anchor example, because it keeps this real. Picture a procurement manager at an Indian refiner. Call her Asha. She has February cargoes booked. She has a refinery slate built around specific crude grades. She has hedges in place and product offtake promised. Now the headline says, switch barrels. But the ship is already on the water. So, Asha's first move is not ideology. It is damage control. Step 1 is the timeline. A reported trade deal headline hits on February 2. The public framing is tariff relief linked to energy sourcing. Then the reality check arrives. Refiners say they need time to unwind. That time gap is where markets misprice. Because headlines price instantly. Physical flows reprice on schedules. So, what is the real mechanism chain? Tariff relief changes trade incentives. The payment is a shift in crude sourcing. That shift changes refinery economics and freight. Freight and grade choices change the delivered cost of oil. Delivered cost changes inflation math. Inflation math changes rates and FX. You can see why this matters in 3 buckets right away. Rates care because energy is inflation's loudest input. FX cares because India's import bill is dollar priced. Credit cares because higher import costs tighten margins. But the first market receipt is usually not the flat oil price. It is the differential, it is the discount, the spread, the basis. That is where displaced barrels go to find a home. Start with the basic fact pattern. After 2022, India became a major buyer of discounted Russian crude. Those discounts were the entire point. Buyers got barrels below benchmark. Russia got a clearing price and volume. If India steps back, those barrels do not vanish. They reroute. They either chase new buyers or widen the discount. That shows up in differentials before it shows up in Brent. Now bring Asha back in. Her refinery is not a generic machine. It is tuned. If she replaces Russian grades with Middle East grades, yields change. If she replaces with US barrels, freight changes. If she replaces with West African barrels, timing changes. Every path changes the delivered cost and the hedge book. This is why a wind-down period is a big deal. It means the policy switch is not a light switch. It is a conveyor belt. So, in the next 24 to 72 hours, what actually moves? First, clarification risk. Markets will trade the difference between reported and signed. They will trade whether the linkage is real policy or rhetoric. Second, the paper market will front-run the physical. You can get a price move on expectation alone, but the confirm is physical indicators, differentials, freight, tender behavior. Third, the spillover into FX can be quick, because importers hedge on headlines. If the import bill is expected to rise, hedging demand rises. That can move the currency even before the cargo moves. Here is a concrete way to think about it. Imagine Asha has to replace 1 month of barrels. Not all, just a slice. If the replacement barrels cost more delivered, her refinery margin narrows. If her margin narrows, she trims spot buying. If refiners trim spot buying, differentials shift. If differentials shift, global flows reprice. That is the first what breaks first angle. The break is not a blackout. The break is a widening discount on displaced crude. The break is a jump in freight on the alternative routes. The break is a change in India's import mix data. Now, zoom out to the cross-asset map. If oil differentials widen, energy equities can diverge from the index. If oil delivered costs rise, inflation expectations can firm. If inflation expectations firm, the front end can reprice. If the front end reprices, the dollar can stay strong. And a strong dollar is a brake on commodities broadly. This is also why the story can look confusing on day one. Oil can be down on risk sentiment and still be tight underneath. Gold can be down on margin mechanics, and inflation risk can still exist. The tape can say risk off, while the physical says reroute, so we do not guess. We track receipts. Receipt 1 is the policy linkage itself. Is there a formal document? Is there a stated timeline? Is it a binding condition or a negotiating posture? Receipt 2 is the wind-down constraint. Reuters' line about February and March cargoes being planned is crucial. It tells you when the physical can realistically change. Receipt 3 is the early physical footprint. Watch for tenders and spot buying behavior. If India's refiners start issuing tenders for alternative grades, that is signal. If they do not, it is just talk. Bring Asha back one more time. In the next few days, she does not flip a switch. She asks for a bridge. She renegotiates timing. She protects the slate and the hedge. That is how reality slows politics. And that is why the market's first job is to price the bridge period, because the bridge is where volatility lives. One more piece people miss is the tariff side. An 18% tariff target changes competitiveness for exporters fast. If that number is real, factories and supply chains react. That is why the story touches rates and FX, not just oil. There is also a second-order channel through shipping. If India replaces Russian barrels with longer-haul barrels, ton miles rise. More ton miles means tighter tanker availability. Tighter availability means higher freight. Higher freight is inflation that does not show up in crude futures. So the clean approach is a dashboard. For headlines, watch official statements and any signed text. For physical, watch differentials and freight. For confirmation, watch import mix prints. You can pull those receipts from real places. Differentials show up in price reporting, like Argus and Platts assessments. Import mix shows up in monthly trade data and ship tracking services. Freight shows up in tanker indices and route rates. If those three areas stay quiet, the story is noise. If they start moving together, the story is real. And if they move against each other, that is the anomaly worth a video. Next, we need to map the barrel reroute, because stop buying is not one decision. It is dozens of contracts, cargo swaps, and insurance checks. That is where the hidden constraints live. Start with how Russian crude actually clears. It clears through a discount and through logistics. The discount attracts buyers. Logistics determines who can take delivery. When one major buyer steps back, the system does not freeze. It reprices the discount until someone else steps in. But someone else is not automatic, because refineries are tuned and sanctions add friction. This is why the first pressure point is not oil price up. It is discount wider. It is delivery harder. It is payment rails riskier. Now, connect that to India's side. India is not a single buyer. It is state refiners, private refiners, and trading desks. Each has different risk tolerance and different contracts. If a policy signal says stop, but cargoes are already planned, you get a transition phase. During that transition phase, the market trades two stories at once. Story 1 is the headline. Story 2 is the clock. That mismatch creates volatility because every participant has a different clock. A policymaker clocks in days. A cargo clocks in weeks. A refinery slate clocks in months. Bring Asha back. Her pressure point is the refinery yield. A medium sour crude does not behave like a light sweet crude. If she swaps too quickly, she risks lower product yield or higher processing cost. She might need different blends or different runs. That is operational, not political. Her second pressure point is the hedge book. If she hedged based on a certain benchmark and differential, that hedge can break. Not because oil went up, but because the spread moved. That is where losses show up first. So when we say what breaks first, this is what we mean. If differentials gap, hedges misbehave. If hedges misbehave, refiners reduce risk. If refiners reduce risk, spot liquidity falls. If spot liquidity falls, volatility rises. And volatility is what shows up across assets. Now move into the global side. If India is less available for Russian barrels, those barrels chase other outlets. Some will try to go to China. Some will try to go through intermediaries. Some will go into floating storage. Each path has a different cost and different time. The reroute costs show up in freight and in the discount. That is why you can see the story even if Brent is flat. Now layer in the tariff angle again. Tariffs are a direct lever on trade volumes. If India's tariffs really drop to 18%, you could see shifts in export flows. That changes the dollar demand picture. More exports can mean more dollar inflows, which supports the currency, but higher delivered energy costs can mean more dollar outflows. So, the FX story is not one way. That's why this is a perfect risk and recap episode. It is a measurable tug of war. And the winner shows up in 3 places. Let's define those 3 signals now, cleanly and simply. Signal 1 is Russian crude differentials. Where to look? Price reporting on Urals, ESPO, and other Russia-linked grades versus benchmarks. What direction matters? A sustained widening discount means displacement is real. Typical lag, days to 2 weeks after the policy signal. Signal 2 is India's import mix. Where to look? Official trade and shipping data, plus ship tracking summaries. What direction matters? A durable drop in Russia's share, not a 1-week wobble. Typical lag, weeks because the data prints late. Signal 3 is freight on the replacement routes. Where to look? Tanker route indices from Middle East to India, USGC to India, West Africa to India. What direction matters? Higher rates and tighter availability implies the replacement is happening. Typical lag, days to weeks, depending on chartering cycles. If those 3 signals line up, you have a real rewiring. If they do not, it is a headline trade. Now we run the stakes ladder through the same lens. In the next 24 to 72 hours, the main risk is narrative whiplash. You get competing statements. You get deal done versus talks continuing. Rates and FX can move on language alone. Equities can wobble on inflation implications. In the next 2 to 6 weeks, the story becomes operational. This is when the tenders, cargo swaps, and route rates matter. If India's import mix starts shifting, inflation expectations can firm. If inflation expectations firm, yields can reprice higher. Even if growth is fine, that can tighten financial conditions. If this persists, it becomes structural. The barrel reroutes reshape who gets discounts. Freight becomes a permanent cost line. Refiners re-optimize, and that changes product flows. That is when the spillover hits the real economy. Now, we should be honest about the uncertainty. A reported tariff number can be framed differently in final text, and energy policy often has exemptions, grace periods, and enforcement gaps. So, the right framing is conditional. If the linkage becomes binding and enforceable, the flow shift will show up. If it stays rhetorical, the physical will barely move. That is the risk boundary. Now connect this to cross-asset reactions in a way a viewer can test. If inflation risk rises from higher delivered costs, watch front-end yields. If the dollar strengthens on rate differentials, watch broad commodity weakness. If volatility rises from hedging stress, watch equity volatility and credit spreads. This is also where a second anomaly can appear. You can see oil calm, but shipping stressed. You can see the currency stable, but the import bill rising. You can see equities up, but credit spreads creeping wider. Those are the plumbing tells. Now, here's the simplest way to explain the whole thing. Trade policy is trying to swap one set of flows for another. But flows live in contracts and ships, so the market has to price the bridge period. And bridge periods are where spreads, freight, and FX do the loudest talking. Bring Asha back for one more update. In the 24 to 72-hour window, she is not buying new barrels yet. She is managing risk. She is talking to traders and shipping desks. She is checking whether she can get alternative grades in time. She is checking whether the hedge will protect her. And she is watching differentials, because that is where the cost hides. That is the anchor scenario. It keeps us from turning this into opinion. Because in the real world, the first consequence is not ideology. It is an invoice. Now, we need to land the final piece. What is the what breaks first pressure point we watch in this story? It is the discount and freight combo. If discounts widen and freight rises together, someone is being squeezed. Either the producer takes a lower netback, or the buyer pays more delivered, or both. That squeeze is the macro consequence. Next, we close with a clean recap and the 3 markers, and we keep it grounded, not predictive. Here is what happened in one clean chain. A reported trade deal headline linked lower tariffs to an energy condition. Indian refiners then surfaced the constraint the market has to respect. February and March cargoes are already planned. So the physical system cannot pivot instantly. Why did it happen? Because trade policy is trying to reroute a large, discounted flow of barrels, and the only way barrels move is by changing incentives. That means either the discount widens or the freight rises or both. And during the transition, hedges, slates, and contracts create friction. Why it matters is the spillover. If India's delivered costs rise, inflation risk can firm. If inflation risk firms, the rate path can reprice. If the rate path reprices, FX reacts through differentials and hedging demand. If FX reacts, commodity pricing changes again, because commodities are dollar-priced. That is why this one story can touch rates, FX, and commodities at the same time. Now, run Asha, our anchor example, through the stakes ladder. In the next 24 to 72 hours, Asha's world is language and risk management. She is watching whether the deal is real, signed, and enforceable. She is watching whether the market starts pricing replacement barrels. She is watching the first move in differentials because that hits her hedge math fast. In the next 2 to 6 weeks, Asha's world is execution. Tenders, cargo swaps, charters. If the import mix starts shifting, her costs start showing up in realized margins. If realized margins narrow, product pricing pressure follows. That is the point where the inflation channel becomes more than theory. If this persists, Asha's world changes structurally. Her refinery optimizes for a new supply mix. Her hedging strategy changes because the spread behavior changed. And the whole market learns a new map of discounts and routes. That is when the trade policy becomes a lasting macro input. Now the 3 signals, not 10, not a watch list you will ignore. 3. Signal 1. Russian crude differentials. Where to look. Price reporting on Russia-linked grades versus benchmarks. What direction matters? Sustained discount, widening signals, displacement. Typical lag, days to 2 weeks. Signal 2. India's import mix. Where to look. Official trade data and shipping summaries. What direction matters? A durable drop in Russia's share. Typical lag, weeks. Signal 3. Freight on replacement routes. Where to look? Tanker route indices tied to India's alternative sourcing. What direction matters? Rising route rates and tighter availability. Typical lag, days to weeks. If those 3 move together, the story is real. If only headlines move, the story is not priced into the physical yet. Now, the risk framing, without doom and without certainty. If the policy linkage becomes binding and enforceable, expect the reroute to show up first in differentials and freight. If enforcement is loose, expect more noise than flow. And if the market front runs the policy and then the physical does not follow, expect a snapback. Last, the clean recap. What happened was a trade headline tied to an energy condition. Why it happened was an attempt to rewire incentives in the oil trade. Why it matters is the inflation, FX, and rates spillover. And what to watch is the same 3 markers this week. Russian crude differentials, India's import mix, freight on the replacement routes. That's the risk, and that's the recap. If you want the clean signal check, look at those 3 markers this week. I'll see you in the next one.